it's a pleasure. And for everyone who's participating in this call, I hope you find the information here useful. So um, so let me just give you a little bit of background as to how we came about this particular project. So there's a good amount of research that shows that Hispanics and Blacks are more likely to use alternative financial services and less likely to own a bank account. And the question, one of the questions that are generally asked by researchers is why do we see these differences? And so many papers have attempted to answer this question by looking at things that one can think about potentially answer these differences, like for example, household income, maybe level of education, maybe household size, maybe marital status, and a number of other factors that you might think would explain these differences. And then even after accounting for all these different factors, we still see that Hispanics and Blacks are still less likely to own a bank account and more likely to use alternative financial services. And so our paper is looking at this particular question, trying to understand this particular paradox as to why we see these differences again when we compare usage with whites, for example. And so what we're going to be arguing here is that that part of this gap may be due to access to these financial centers, and particularly we're going to be focusing on banks and branching in the local areas to try to explain this. And so this is more or less what we're going to try to show you here. I'll let me before I show you the results for the poll, let me give you an illustrative example here of what we have in mind. So here are two cities, Santa Monica and Bellflower. So Santa Monica, many of you I'm sure know where it's at. It's right here by the coast. And then Bellflower is down over here, south of Downey, north of Lakewood, in between Compton and Norwalk. These are perhaps not the best illustrative comparison cities, but I think we'll derive some generalities that will carry forward for the presentation that I'm going to give you here. So just let me just give you a little bit of stats on these two cities. The population in 2019 and in 2010 are roughly the same. In Santa Monica, roughly about 90,000 people live in this city, and it hasn't really changed over the last 9 years. Bellflower is about 77,000 people. Again, over the last 9 years, the population has not really changed. So they're roughly about equal size, and not much growth here in terms of population. When we look at things like household income, for example, we see big differences. So the median household income in Santa Monica is roughly $97,000 per year, while the median household income in Bellflower is $60,000. So clearly, people in Santa Monica or households in Santa Monica earn an average about a third more than people in Bellflower. When we look at per capita income, we see that clearly people in Santa Monica make a whole lot more. 3 times as much as the average person in Bellflower. So clearly these two cities tells us something about differences in income. And then this differences in income are likely to influence how banks decide to service these two particular cities. So here, the first data that I have here is branches in 2010 branches in 2010 in Santa Monica. There were 33 versus 8 in Bellflower. So here we see 4 times more branches in Santa Monica versus Bellflower, even though the population is only 15,000 people less in Bellflower. The number of branches actually increased in Santa Monica to 44, so they gained 11 branches, while Bellflower lost 3 branches. And the number of banks servicing Santa Monica actually increased from 12 to 17 in the 10-year period, while the number of banks servicing Bellflower decreased from 7 to 5. So just in this, crude illustrative example, we see here that the differences in income has this really large differences in how these markets are served in through the banking system. And so part of the answers that, or part of the question that we're going to be asking is, how do these differences explain observed differences in uptake rates of bank ownership among blacks and Hispanics? So just if you were wondering which ones were the banks in both cities in 2020, these are the banks that represent that are present in both of these cities. Clearly, here we have the five. Three of the largest banks: Bank of America, J.P. Morgan, and Wells Fargo, and then Union Bank and U.S. Bank. The same banks are also in Santa Monica, plus a whole lot more. So let me just quickly share the results for the poll. So in this poll here, so the first question is mostly a subjective question. Is just how do you perceive banking services? And most of us, including myself, believe that over time we've seen more services available. Particularly, I would venture to guess many of you thought that maybe online services have made it relatively convenient. The second question asked about how many banks had a physical presence in LA County, and the actual number, and I forgot what the actual number is now. The actual number is 98. So there are 98 banks that service LA County. Most of you were in the 21 to 50 range, so it's a little bit more than that. The third question asked the number of branches in 2020. And it turns out that the number of branches in LA County has decreased by 2.3%. So this 30% of you guessed it right. So there are roughly about 1,700 branches in LA County in 2020. And then this last question asks about deposits in LA County. And the deposits in LA County have actually increased by 114%. So the correct answer here is the first one, increased by more than 100%. So we've seen deposits increase to about $523 billion in local branches, doubling what it was in 2010. And at the same time, we've seen a decline in the number of branches servicing the area. Okay, so I'll stop sharing here. So I'm going to go ahead and continue for my 20 or so minutes. I'm not going to give you the. I'm not going to go over our estimation. I'm going to basically lay out the framework of the paper and provide you the summary of our findings, and then we'll go ahead and start in a couple of discussion questions I think will be interesting based on the poll questions. So what do we do? So we examine frictions in the banking sector caused by the Great Recession period to explain variation in individual choice of financial services. And by choice in financial services, we mean bank account ownership and alternative financial services use. And I'll define these in a little bit more in a second. We stratify MSA into three categories of bank intensity of bank failures. Low, medium, and high. So just to give you an idea of what we mean here. So in 2008, for example, Washington Mutual of Henderson, Nevada failed. And Washington Mutual had branches in many places, mostly across the West. And so, for example, the LA Metro, which includes LA County and Orange County, had roughly about 200 branches. So what we're going to be doing is we're going to add up all the branches of all the banks that failed between 2008 and 2011 for any given MSA for any given MSA, and we're going to divide that by the average number of branches over those years in those MSAs. And that's going to give us a measure of bank failure intensity, either being low, medium, and high. And if I'm not mistaken, I believe the the metro, LA Metro was roughly was a medium intensity place. Okay, so we're going to examine bank failures on the choice of financial services use using data or survey data from the 2013, 15, and 17 um, bank and unbanked surveys that are conducted by the FDIC. I'll say more about this data set in a second. But we're going to be looking at individuals' responses to their financial services use. We contribute to the literature and that determines the financial services use in the United States and the effects and the real effects of bank failures. So just as a way of background, our paper posits that bank failures had the opposite effect as these deregulation. So the area of deregulation is assigned in two parts. So for most of the U.S. history, there's been large number of regulations in the banking sector. Starting in the 1970s or so, there was this some first wave of deregulation where states allowed banks from other states to come and compete in the state markets. But usually this was done ad hoc. So, for example, in order for a bank from Nevada to enter California, you would need some sort of reciprocal agreement where Californian banks would be allowed in Nevada, for example. So it was very ad hoc. States determined how these deregulation was going to take place. And so during this period, what we observe is that banks out of state banks were consuming small regional banks, and so this led to a contraction in the number of banks. Although it is a period that is considered to have led to an improvement in the performance of banks because of efficiency gains in governance and other structures that these banks brought into the areas. However, after the Interstate Banking and Branching Efficiency Act, or the Regal-Neal Act of 1994, the states really lost a lot of power over banking regulations within their borders, and so most of the power was given to bank regulators, and this allowed for an expansion of branching into other states without the need to have a holding company or a headquarter in the state in which you're servicing where you're providing a service. So again, think about the Washington Mutual example. They're based in Nevada. They were based in Nevada, and they had branches in California, and they were not required to have a headquarter office in California. Okay, so much research has showed that this period after the late 1990s into the 2000s, that this led to a large number of bank competition, and so and also an expansion of branching across the United States. So in a paper by Celarier and Metre, they find, for example, that branch density increased by around 20% in poor counties after states fully deregulated. So we're going to be using this. So we have in mind that bank failures will have the opposite effect as this Regal-Neal Act did in the 1990s, early 2000s period. Okay, so why do we think that bank account ownership is important? So participation in the formal financial sector through bank account ownership is a first step towards building credit history and a pathway to the formal credit market. Access to financial services facilitates savings, investments, wealth accumulations, and give individuals a sense of control over their finances. So a bank account can facilitate asset building and wealth creation that affect consumption smoothing, retirement savings, and protect against income shocks. Access to financial services provide low-income households access to affordable credit and tools to better absorb financial strains. Without an inclusive financial system, the poor must rely on their limited savings or earnings to invest on things like, for example, education or to pursue entrepreneurial endeavors, which has implications for social inequality that we currently observe. So there's as I mentioned at the beginning, there's large differences in race that have been observed in the literature. So, for example, Ryan and Green find that race, education, family income, marital status, geographical location play an important role in explaining financial services use. Additionally, when exploring channels through which the bank become unbanked, they also show that declining family income, loss of employment, and loss of health insurance coverage are key underlying factors. Ryan Green in their 2006 paper find that immigrants with less education living below the poverty line or in large families are more likely to be unbanked, and your very own Dr. Blanco finds that older minority adults are less likely to own a bank account, showing that 10 to 13% of minority couples are less likely than whites to own a bank account. So why do we think this is important? So the lack of a bank account can make liquidity management and payment difficult and result in higher fees when using money orders or check cashing services. So for example, if you don't have a checking account and you need to pay your electric bill, so you obviously cannot write a check to pay this bill. So you have to find ways to be able to make this payment. One way, for example, is to go and buy a money order, but these money orders have fees associated with them, and makes living being poor or living without a bank account ownership slightly more expensive, or face higher transaction costs than somebody who does. Cash transactions present financial and personal risks since individuals have limited recourse if funds are stolen. So if you carry all your life possessions with you in your wallet and you lose your wallet, then you have no good way to insure against this. Cross-sectional studies have found that the lack of geographical proximity to a formal financial institution is a factor that influences the lack of participation in the formal financial sector. And Goodston and Ryan finds that access to a branch within 5-mile radius increases the chances of having a bank account and reduces the likelihood of using alternative financial services in the U.S. And in some sense, this is what our paper is going to be arguing here, that the period of bank failures, particularly during the Great Recession period, is led to a reduction in branching, which led to an increase in alternative financial services used by minorities and a decline in bank account ownership. So where do we stand? So our paper is related to a small body of literature that explores the effects of local financial institutions, access to local financial institutions. So as mentioned earlier, Solaria might try to find that expansion of branches increased participation in the formal financial sector among low-income households. Brown's paper finds that access to local financial institutions in early life in Native American reservations, for example, benefit long-term consumer credit outcomes like improved credit scores and less account delinquencies. We focus on the effects of bank failures in the Great Recessions on individuals' use of financial services in the post-Great Recession period. So this period has, in our data, there's roughly about 400 banks that failed during this period. So we're going to use variation of where these banks had branches in to try to explain or identify the effect of branching. Understanding the importance of access to banks is important because it may also affect social justice, economic equity, and overall financial security. Lack of access can deprive, in particular, the poor and minority communities of relationships that facilitate access to formal networks, information networks, and credit. Okay, so we're going to be using the biennial Federal Deposit Insurance Corporation, or FDIC's National Survey of Unbanked Underbanked Households. So this survey is actually administered by the census through the CPS, the Current Population Survey. It's a supplement that is conducted every 2 years. We're going to be using the 2013, 15, and 17 versions of the survey, and we're going to pull these surveys together. We do not use the 7, 9, and 11 surveys because we're not able to identify those who only use alternative financial services or only have a bank account. So this is why we stick with these 3 years. And then the added bonus is that this happens to come at the post at the post-recession period. So our sample consists of roughly 83,000 individuals residing in roughly 150 metros in the U.S. Okay, so we're going to be actually before I go, how much time do I have, Luisa? Or
I will say like what, like another 10 minutes if you want.
okay, yeah, it should be perfect. I should be done by 10 minutes. Okay, so let me first define some of these key variables. So we have individuals who are fully banked, and those are individuals who own a bank account, and do not use alternative financial services. And just in case you're wondering what alternative financial services are, again, think about the money order services when you go in to buy a money order, so you can make a payment. But you could also think about other things. So, for example, payday loans. So imagine, for example, that your rent is due today, but and today is Monday or Tuesday. I don't even know what today is. Today is Monday, and but you won't get paid till Friday. So you go to one of these payday loans, asking for a advance on your paycheck, and you use this money to pay your rent. And then at the end of the week, when you get your paycheck, you pay them back the amount you borrow plus interest. And these places are notorious for charging hundreds of percent APR on these loans. And again, you can think of more egregious type of entities like title loan entities, where you need to borrow money, again using the hypothetical example of needing money for paying your rent. You don't have the money, so you take your car title to a title loan company, and they'll give you an advance, or they give you a loan on using the title as collateral for this loan. And then a few days later, a week later or so, you return you pay back the loan plus the interest fees, and you get back your title. So anyway, so this will be the type of alternative financial services that people would use, and some reasons why they might prefer alternative financial services over owning a bank account is because maybe if you have irregular income coming into your bank account, it may be difficult to balance your account, and you may be predisposed of overdrafting your account, in which case you're likely to face high fees. So you might not want to do that. Anyway, so that's so we have four categories. So we have the fully banked, we have the underbanked who own a bank account and also use alternative financial services. We have the unbanked, those individuals who do not own a bank account but use a alternative financial service. And then we have individuals who are cash only. That is to say that they neither own a bank account nor use alternative financial services. And again, you can imagine people just carrying around cash on their pocket and making their payments by visiting the locations and paying in cash. Okay, so let me just show you some descriptives to think about these racial disparities in financial services use. So roughly 95% of our sample owns a bank account, 18% use alternative financial services. If we look at this table over here, which I call table 2 in the paper, we see these large differences across race. So here we have white, black, and Hispanics who are fully banked, underbanked, unbanked, and cash only. And what you can see is that 86% of whites are fully banked. This compares to 61 and 66% of blacks and Hispanics, respectively. So clearly, blacks and Hispanics are far less likely to be fully banked than whites, and blacks and Hispanics are far more likely to be underbanked. That is to say, they have a bank account and also use alternative financial services. Again, roughly a quarter of African Americans and Hispanics are underbanked. And interestingly, here is that blacks and Hispanics are far more likely to be cash only. 5%, roughly about 5% of these two groups are cash only, compared to only 1% of whites. So again, we're trying to understand these differences in our paper. So what we're going to be using is we're going to be using bank failures to try and identify this effect by arguing that bank failures led to a reduction in branching, which led to a reduction in access to a branch, which led to a reduction in the use of or owning a bank account and use of returning financial services. As I mentioned before, between 2008 and 2011, there were roughly about 400 banks that failed in the U.S. And what I have here is a number of branches that were impacted every year from 2008 to 2011. At least that's what we're going to be using for to measure bank failure intensity. So in 2008, roughly 2,600 branches were affected by bank failures. Again, to go to the example that I gave you earlier, when Washington Mutual failed in 2008, they had almost 200 branches in the LA Metro. So those 200 are part of this 2,600 branches. So what we do is we add all these branches, but we add them by metro level, and what we do is we then divide this by the average number of branches to come up with our measures of bank failure intensity. So let's think about this branch density issue. So there's two things here that need to be pointed out. The first, and I think, well, first let me tell you what we have here. So what we have here is I have 4 different groups, and by groups here I mean metros. So we have metros, we're calling here no treatment, and these metros are metros that had no branches of banks that failed in the 2008 to 2011 period. And then we have those who are of low intensity, medium intensity, high intensity, again, as we defined earlier, with the total number of branches that were impacted over the average number of branches in that metro. Okay, and then here we have the branches per 1,000 people. So just to think about this, 0.347. So before the Great Recession period, in 2004 to 2007 period, before the Great Recession period, in no treatment metros, there were roughly about 35 branches for every 100,000 people. That's how you would read this number. And in the post Great Recession period, from 2012 to 2015, there are roughly 33 branches for every 100,000 people. So in all of these cases, one thing is obvious is that the branching has declined in the U.S. It doesn't matter what the intensity level is. There's just simply less branching going around. And the good example is the one that I brought out earlier, where we have Bellflower in Santa Monica. Actually, well, Santa Monica is the exception, but we've seen branching decline. The second thing that I want you to take away from this picture here is that in high intensity metros, the difference between pre and post Great Recession period is largest. So roughly a difference here of 0.02. In high intensity metros, the lowest intensity is the lowest difference is in no treatment metros, and then low and medium intensity metros are somewhere in between. So we believe that this is telling us a story here that high intensity is associated with more branching disappearing in these metros than for metros that had fewer or less intense bank failures or didn't or were not exposed to bank failures in the Great Recession period. Okay, so let me just show you a couple of descriptive statistics here. I already mentioned that 95% own a bank account and that 18% use alternative financial services. I also want to point out that the individuals in our data are relatively equally distributed across the no failure, low intensity, medium intensity, and high intensity metros, roughly about a quarter in each of these groups. The average metro is 28% minority. The average metro has a million people. The average respondent is roughly about 51 years of age, and yeah. So this is just some descriptive stats. I'm going to uh, and then so let me just give you one more table before I just give you some general conclusions of what we find here. But it's interesting here that whites, that the distribution of whites, blacks, and Hispanics across the different types of metros. So it's interesting that whites are mostly live, at least in our sample, in no failure and low intensity metros. So roughly about 57% of whites live in no failure and low intensity metros, and only 20% live in high intensity metros. Blacks, we see that the majority live in low intensity and medium intensity metros. So roughly 64% or so of blacks live in these low and medium intensity metros. And Hispanics, roughly about what is it, 73% or so live in medium and high intensity metros. So here we can clearly see that there's differences of where individuals live. That blacks and Hispanic live in metros which were exposed to higher levels of intensity, and Hispanics in particular live in metros that had high levels of intensity. So let me just wrap up here as to what our main results are, and then we'll have a couple of discussion questions. So using the 2013, 15, and 17 National Survey of Unbanked and Underbanked Households, we find that exposure to bank failures in the Great Recession period reduced the probability of being banked and increased the probability of being unbanked. The adverse effects are most pronounced on blacks and Hispanics. In particular, middle and high income members of these groups were the ones more affected, which is interesting because I think most of us would believe that are actually members from low income communities that are most affected by these changes by these effects of bank failures. Our findings are consistent with the literature on bank mergers and acquisitions that show that the benefits of mergers can be offset if mergers reduce communities' access to banking services. And our results point to a significant societal cost of bank failures that fall disproportionately on minorities. These may in turn lead to other deleterious consequences such as a lack of savings, investments, and personal growth activities, and access to credit. Again, factors that are likely affect levels of inequality that are observed in our society. Okay, so this is basically the presentation that I wanted to present here. And so what we did is we produced a couple of questions that we think we can use to that we think we use as discussion and thinking about some of the information that I presented here. The idea is that we'll go into these breakout sessions, maybe 5 to 10 minutes, discuss one of these two questions, depending on which group you are assigned to, and then come back, discuss these issues, and I'll take whatever other questions you may have on the presentation I just gave. So the first group is to think about formulating public policy. How can technology be used to help individuals gain access to the formal financial sectors? And in particular, think about the paper that I just presented here. It seems that some individuals may not necessarily be tech savvy. And so let's focus on the marginal users who may distrust a system that lacks human contact. And you can imagine why this may be the case. Maybe you are in communities that are far more likely to be taken advantage of by scrupulous individuals, by example, from people over the phone. And so you may trust more establishments where you can see individuals face to face. And then the second question is, what solutions can the private or public sector put forward to help bridge the gap in access to financial services used by minorities? And again, you can take any aspect of this. You may believe that maybe the private market is already supplying whatever it chooses to supply, and maybe there's whether you're actively involved in it is not the private or the public sector's business. That's one view you can take, or you might decide that this is a public good, and the public sector government has some role into making sure that access is available, and what role can the private sector take in meeting these needs. So these are the two general questions. I don't I don't know how we're going to be breaking up here into
Mhm.
groups.
Yeah,
Dr.
thank you,
Blanco.
Salvador. I think
Yeah.
this is great. Thanks for the great presentation and for the discussion questions. So now Melissa, who is our event coordinator, she will be putting us in different breakout rooms. So I'll be the moderator in one of room 1 with question 1. And then Salvador will be the moderator of room 2 with question 2. For the breakout rooms, I think let's just keep it around 5 minutes since we are at the 12:39, so that will give us time to come back and report. So I will say 5 minutes, and then as you go into the room, having a camera on, if you can, put it on. If you can't, not a big deal. And then in the chat, as you join the room and everyone is there, we will ask you just to say, you know, are you a first year student, second year student, faculty, staff, you know, just to kind of get a sense of like who's in the room. But I think we're ready. So Melissa, if you could please help us to go into the breakout rooms. Thank you.
Great. Opening breakout rooms now. You should see an icon appear on your screen.
Okay, so almost everyone is coming back. So how about Vanessa reports to the group some of our answers, and I will say pick 2-3 main points of, you know, what was discussed and what we think is, you know, important as we think about the use of technology. And then Ryan, for your group, also try to pick, you know, 2-3 things. I mean, try to do it like in a 2-minute summary on the report, and then hopefully we have like a couple minutes for open questions to Salvador. Okay, go ahead, Vanessa.
Okay, so some of the points were that technology may be developed, but we must address distrust in communities. That text message social services that provide financial services might be something we might look into. It might be beneficial for the communities. Working with children within public schools to encourage financial service use at a young age and also to bring back to their families might be something beneficial as well. There's also that technology is there, but there are many barriers to address simultaneously. And that technology keeps increasing and it's getting more difficult for people to use these platforms. But also a very distinct point I think that someone made was technology cannot solve social issues, but it can bridge the gaps. And that we assume people have access to technology and the discrepancies in access because some people don't have reliable Wi-Fi, and we must also improve these infrastructures for people, as well as to see how we can provide people with technology if we're going to utilize that through financial services.
Okay, thank you, Vanessa. So now I'm going to let Ryan kind of report back on the discussion from the other room, and then if there are questions to Salvador, then I'll moderate that for the last 4 or 5 minutes. Go ahead.
Yeah, so we had a couple of interesting ideas in our group. One of the ideas we talked about was using citywide Wi-Fi and public libraries to increase access to online banking and other financial services might be a good way to help with this problem a little bit. We also talked about possible barriers to those solutions, including how do you deal with the lack of trust associated with the traditional financial system, and would these solutions overcome it? And I don't know if our group really reached a consensus on that, but I think it was an important question that we were all thinking about.
Thank you, Ryan. Yeah, it seems that some things overlap, which is great. I mean, it seems that we're thinking alike. So I think now what I'll do is if there are, I'm gonna try to have you as so if you guys, I guess let's just spend like 3-4 minutes. If anyone has a specific questions to Dr. Contreras, please use the reaction so I can look at the screens. I'll be kind of scouting because I have 3 screens, like a lot of people today. Yeah, great attendance. Anyone has any questions for Dr. Contreras as we wrap up or any sort of discussion around this issue, please use the motion, raise your hand, and then I'll look for you, and hopefully we'll do the last 2 questions, comments. Anyone? Okay, I see someone raise your hand. So was that Allison?
Yes.
Oh yeah, go ahead. And then you work on the financial sector, right? So maybe you want to share that briefly to everyone.
Yeah, I actually work for Bank of the West. I'm a small business and relationship banker there. But my question to you, Salvador, was I know you said that proximity to some of these communities is the issue as far as the physical branch goes. And you kind of used like the 5 mile radius mark as the judge for that. In your personal opinion, in your research and findings, what is the solution to, the lack of physical branches? For example, Bank of the West is a small bank. I know that we're not in some of those smaller or lower income communities because we can't physically afford to be. So I'm just kind of curious as to what a solution might be to that.
Well, I don't know the solution. If I did, I would have brought it forward. So the paper was trying to somehow identify what one of these factors was, and we think we uncover one, or at least we think we properly identify the effect of branching. And just as you pointed out, Bank of the West may not necessarily find it profitable to be in all communities, especially communities where there may not be a big deposit base, or for communities for which they're not going to use, like lending services, or for example. So it's tough. I don't know what the answer is, but it is clear that many individuals, a good number of individuals, are not attached to the financial system because either there's not a local bank next to them, or ample of options in their way to work, or in their commute, in their daily commutes. So it's not clear what the answer is. One can think of potential regulation in which maybe large banks, let's say banks with some sort of large number of assets, say I don't know 50 billion or so, some large number of assets, maybe they be required to both to have some presence in communities that are more representative of the areas that they serve. So, for example, the Community Investment Act mandates that banks, when they make lending, that they also not redline certain communities or individuals of certain economic backgrounds. And so this is one way in which policy has been used to try to address these, not servicing certain communities. So maybe this is one way, perhaps not a perfect way, but a way to address this issue.
Let me jump in quickly. So Justin, if you want to make your comment question like in 1 minute, and then Salvador respond in another minute, and then we wrap up. Go ahead. Thank you.
Sure. So my question is, yeah, you found a correlation in AFS services, AFS, which would be services, and a lack of branches. But what did you find as far as like how significant is that to the problem? And if AFSs are able to find profitability in these neighborhoods, why can't banks compete with at a loan level with those services?
Yeah, I actually don't know why a bank does not enter the payday loan business. There's probably regulatory reasons why they don't do this, but there's certain types of loans that the banks will not touch based on the level of risk. So, for example, if I live paycheck to paycheck, and I may or may not be able to make my rent this month, you may not want to lend me any money. And so there'll be entities that are willing to take high levels of risk by charging a really high interest rate, and that will be their compensation for that level of risk. So it's likely that the risk management within the banks do not allow them to lend to certain types of individuals. That's my guess for that part.
Okay, well, thank you. Yeah, Alison responded mostly like FDI regulations and too much risk, right, with payday loans. But thank you so much. So it's 1 o'clock. I want to be mindful of everyone's time. Great presentation, Salvador. I appreciate your time to share with our students. And then thank you for the students for being here and having a great conversation. So have a great rest of the week, everyone. And
thanks, everyone. Thanks for having me again.
Thank you.
Bye-bye.